Okay, well, the basic argument, I guess, is in the title. So we wanted to argue that the banking crisis was caused by two driving forces. One, a kind of imperialistic set of bankers who created banks, innovated new ways of making money, and up to a point bent the financial system to their will, got the regulations that they want, and were left at the end of that process extremely wealthy and, in their own eyes at least, and for a period of time, masters of the universe. But at the same time, they created a trap. And the trap was that the search for profitability pushed them into the need to make ever higher profits, because they were operating in a market environment in which any target they reached became the higher target for the following year. So up to in 2007, 2008, financial system looked strong, banks were making ever larger profits, but actually it was a kind of a Jenga tower. They were just piling more bricks upon bricks, and eventually the whole structure had to give way. And the tragedy of it was that once you got caught into that system, it was very difficult to get out. Well, for sure, if we know anything about financial crises, it's that they happen, and they tend to happen at the moment when everyone's forgotten about the lessons of the previous one. So if you look at bank balance sheets now, there's some pretty strong evidence that banks have engaged in some pretty serious lesson learning in terms of their risk levels, in terms of the kind of things that they're doing. On the whole, and touch wood, banks look a lot safer than they were before. And it also helps here that the Bank of England, through the Financial Policy Committee, has actually forced the hands of the bank by raising capital levels, by ring-fencing the banks. The system looks a lot safer. In a sense, the question is not whether the banks are safer now in the UK, it's about whether the banks are safer in other parts of the world, and it's also, for the UK, about whether those lessons that appear to have been learnt now will be remembered a decade or 2 decades down the line when the next gold rush mentality hits. I think up to a point they've learnt a great deal. So if you talk to people at the Bank of England, someone like Andy Haldane, former executive director of financial stability, they'd sound incredibly critical of the banks, and certainly a view that was prevalent within the Bank of England and within the regulatory bodies, that bankers know best, that the markets always work and that markets are efficient. I think those days have gone. So they've stepped in and they've forced the banks to behave in ways that make them safer. At the same time, there's probably a limit to that one. We don't touch upon this too much in the article, but I guess the analogy here is that what they've done is they've put in some pretty safer fire extinguishers. They've made the banks safer in case a fire breaks out. What they haven't done, and where they've drawn the line, is in terms of intervening directly to direct the banks to engage in certain kinds of activity and not in certain kinds of activity. So banks are still free, for example, to make a large chunk of their profits from financial trading, which I'd argue is inherently less stable than other traditional forms of lending. The Bank of England and other regulators have made them put more money aside to cover their losses, but they haven't intervened directly to try and control what it is that they do. So one of our arguments here is about competition, and when we look comparatively, when Steve and I started working on this when we were living in Australia, and Australia and Canada were two of the financial systems that came through relatively unscathed. So of the 4 largest Australian banks, not a single one made a loss in any single quarter during the financial crisis, and there was only one Canadian bank that made a loss. So the question becomes, what was different about them? And up to a point, well, they're not global financial trading centres, so at one level the argument's quite obvious. But digging away at that one, what we also think now is that the competitive pressures in the Australian market were far less intense than they were in the UK and in the American markets. So I talked about how banks were forced into trying to search for ever higher profits. They were caught in an arms race, and the reason they were caught in an arms race is that the market structures were incredibly competitive, and any large bank that stood still would be gobbled up or taken over by a smaller bank. Sitting here in Edinburgh, we've got the example of RBS, of course, which went from a relatively sleepy backward bank to suddenly being a global player in the space of almost no time at all. It's a ferociously competitive market. Not at always and at all levels, but generally there was an intense competition. It's strange, if we think about the LIBOR scandal, for example, that arose because of collusion between the banks. And certainly regulators think that the problem with the banking system in many respects is that it's not competitive enough. We argued in the book that actually competition drove a lot of the risk taking. And what we're doing now with a wider body of countries is trying to empirically substantiate that by looking at and trying to measure competition and changes in bank balance sheets both before and after the financial crisis.
Well, Andy, major congratulations to you and Stephen on your award here. Just for our viewers at home, you can show that to them. It's a terrific piece of work, and we are very honored to have published it in the BJPIR.